Moody's credit agency recently downgraded the American credit rating to AA from AAA. They were the last credit rating agency to maintain a AAA rating for US debt. The impact of this is a lot bigger than most people realize because funds all over the United States and the rest of the world actually have covenants that forbid them from investing in sub-AAA government debt. A whole lot of money just became unavailable to the United States Treasury market. Today, we get into not the short term, but the long term 5-10-year impacts of this downgrade with my guest, Lynette Zang of Zang Enterprises. Welcome to the VRIC Media channel, the most trusted voice in metals and mining. Here's Lynette Zang. Enjoy.
This is Jay Martin.
Okay, here I am with Lynette Zang back on the program. Lynette, it's great to see you again.
It's good to be here, Jay. Thank you for having me.
Yeah, my pleasure. There's a handful of directions I want to go with you today, so we're gonna move fast.
There's so much to talk about.
There's a few things going on. Here's where I want to start. A lot of chatter from my subscribers about the recent downgrade of U.S. credit rating by Moody's, right? And I emphasize Moody's because there's sort of two schools of thought in this. I'd love to know what you think. One would be, this is monumental. This is a shift that the world is going to notice and will impact the perception of the United States for the foreseeable future. This is big. The other school of thought would say, actually, Moody's is just late to the game. Fitch already downgraded, S&P already downgraded. So the United States was already split rated AA. Moody's is just the last to join the party. Maybe it's not as material as people are making it seem. What do you think about either of those two concepts and thought processes?
I would combine the two together.
Okay.
Actually, I do think it's a huge big deal because any mutual funds or ETFs that can only carry AAA rating in them, while they were still, at least while Moody's still had them at AAA, they could still hold those bonds in those funds. However, right? So I don't think we have felt the reverberation of that downgrade in the fund market, in the bond market yet. I know the stock markets just kind of went ho-hum, but the other problem that I see with it is I think that was kind of almost sort of, but not quite, the canary in the coal mine, because we've been having failed bond auctions, and Japan just had a major failed bond auction of their 20-year bonds going back to, what year was that? 1987. So you're looking at two of the largest bond issuers that are having challenges in this debt market. The debt bubble already popped. It's already in structural decline as of 2022. Those things don't go away. They just kind of get papered over. So I think that we have not yet felt the impact of that downgrade, particularly when you consider that it's the 10-year Treasury that's supposed to be the foundation or the bedrock of the global bond, of the global financial system. And what does that say? We don't have bedrock, right? Those prices are extraordinarily volatile, and that's really started evolving starting in 2015. So yes, I do think Moody's was late to the party, but I think that it is very significant in that there are going to have to be a lot of funds that are, and maybe they're in process of it, already selling those bonds off of their portfolios because they are no longer AAA rated bonds. And at the same time that the world is turning away from our government bonds, at the same time that we have to issue a whole bunch of government bonds, and we've got a looming debt ceiling, which, I mean, yes, I think it's a very big deal, and I don't think we've felt the impact of it yet, but we will.
Okay. Thank you for that. So that's really interesting that there's, of course, a large selection of funds that cannot hold sub AAA bonds, but because Moody's was still holding that AAA status, they could use that as effectively an exemption to qualify. Right. And
exactly.
so that's it. That's really interesting. Because S&P downgraded in 2011, Fitch in like 2023, and Moody's now. But it is important because maybe all you need is one AAA rating to justify this to your management. You can still buy the bond because look, Moody's says the AAA. Okay. That's interesting. Okay. I appreciate that. I found myself looking up what countries are still AAA rated. There's 11 right now, and some that kind of make sense, like Switzerland and Singapore, Norway. Also some that struck me as curious, like Canada and Germany, whose debt to GDP may not be as disastrous as the United States right now, but their economies sure aren't doing well. Do you think there's going to be any more distribution, all that fund capital that can no longer invest in US bonds? Where's it going to go? Is it going to look for other sovereign bonds, or what are your thoughts on that?
Well, I think in that arena, it's going to have to look for other sovereign bonds that are AAA rated to make up that difference. And that just goes along with the trend of turning away from the US and the US markets. But you brought up Germany, and I think it's quite significant as well that they're opening up to more debt, right? Because they were always after their hyperinflation and that experience, they were always hyper focused on maintaining a certain low level of debt, to your earlier point. And now loosening up those debt markets and growing that debt. This is all an indication of where we are in the life cycle of this fiat garbage currency. It just gets more and more and more disgusting and dirty and obvious. And when you have major countries that like the US and remember the yen carry trade, look at what's happening in Japan. They've had control over their yield curve, XYZ, ABC. I mean, they're really the ones that showed the world how to control their bond markets. And what I'm seeing is, what was it, last August, where there was the panic around the yen carry trade because they raised interest rates a little bit. And that means that carry trade was unwinding. And boy, they just backed off so fast to that. But it looks like that yen carry trade is unwinding again. So all they did was kick the can down the road, not even a year. And I think that's the bond market is the most significant thing for sure that I'm watching.
Yeah. Okay. That's interesting. And that yen carry trade, the catalyst for that was increased rates effectively on their. Okay. Yeah. And we're headed back that direction potentially because appetite for Japanese bonds is at an all-time low since 1987, which you just explained. Strikes me as significant maybe that, U.S. Treasury auctions have been weak as well. And Japan's the largest foreign holder of U.S. Treasuries. Those two countries have that in common. That's interesting. So that's a little bit of an indicator that if we see rates go up again in Japan, and sorry, just to make sure I understand this, what will you be watching in the Japanese bond market to give you an inclination that more or the next tranche of the yen carry trade might begin unwinding?
Well, honest to goodness, it probably is already starting to unwind because they had a huge spike in yields just yesterday, right? And so the repercussions of that, it'll make the Japanese yen stronger because as the carry trade unwinds, they're going to have to buy back those yens. That'll make that stronger, but that's going to have global repercussions as well. So we see two of the largest bond buyers. And by the way, even though Japan is definitely one of the largest holders of treasuries, they actually started buying fewer and holding fewer of our treasuries back in 2013, as did China, which is another large holder of our treasuries. So to me, when I look at the graphs on how they've been liquidating and not accumulating, it looks to me like there was a run on the dollar that started back in 2013 from these two large buyers of our debt, because our debt is a proxy for our dollar. So just like there was a run back in the 60s from the world sending in dollars to convert to gold and pulling the gold out of the system, and then that was kind of the death knell, and it triggered and transitioned us into a pure debt-based system. I think right now we're seeing the same kind of action in the bond market between China and Japan. I think it's still stealth, but with what just happened in Japan and that the unwind of the carry trade, I don't think it's going to be as stealth anymore. But this has repercussions on a global basis, because in a carry trade, they're borrowing yen cheap and then they're deploying that elsewhere to make money. And now that all of those trades are going to have to be unwound, maybe not all of them, but most of them, they're going to have to be unwound. So this is a big global unwinding when we're already at an extraordinarily precarious position. Boy, all I can say is, got gold and silver in your possession?
Right.
Because you better have it for what lies not that far ahead.
The smartest investors know that real wins come from thinking independently and spotting opportunities long before the crowd. And that's what we teach at the Commodity University.
And so just to flush that out a second more for our listeners, the yen carry trade was effectively an arbitrage trade. You could borrow very cheap in Japan, reinvest that cash where rates were higher. So you borrowed at 3% Japan, invest at 5% somewhere else. That 2% spread is your margin. That makes sense as long as Japan keeps and forces their rates low. And as soon as they can't do that anymore, that's the unwinding. That arbitrage trade vanishes. Suddenly you're caught underwater and you need to unwind or get out of that trade as quickly as possible, which usually causes, and did last August, as you mentioned, cause a massive panic in the market. So I'm curious about the redistribution of capital from funds that can no longer invest in U.S. bonds because they're no longer AAA rated. Yeah, they'll look for other sovereign bonds. I'm also curious, and I'm aware this is somewhat of a loaded question between two gold investors, but I'm curious how, some of them will probably follow the central bank trend of just buying physical gold. Right? We're seeing this trend over the last 3 years. For lack of a better idea, I guess, central banks all over the world are buying gold, but they're buying it in bigger amounts than they have in 40 years, which is interesting. And, if you were to think about the trickle down effect of that, will these funds look at that activity, come to the same conclusion with the same results? Some of them will, I imagine.
Probably. But I think it's funny that you said for lack of a better option. I mean, what is better than 5,000 years of history?
I agree with you.
Better.
Yeah.
It's the kind of trade that allows you to sleep at night.
Yeah. Well, and I agree with you, but I know that we're novel in that thought process. Actually, there's a Canadian gold miner, West Red Lake Gold. They're up in Ontario. They recently gifted the Premier of Ontario a gold nugget that they pulled from their mine. They just moved to production a few weeks ago. Ford, what's his name? Premier Ford. I'll remember his first name in a minute here. Okay. His brother was infamous for his term as mayor of the city of Toronto. Anyways, the Premier made this video. He's holding the gold nugget and he said, "Thank you so much. This is the first piece of gold I've ever owned." And that was just like, yeah, that's normal, right? Like, effectively, a governor level leader up in Canada. He's a premier, never owned a piece of gold in his life, which is normal for a lot of folks.
Well, it really is. And that is a really sad thing. And we at Zang Enterprises are doing some things to counter that. Because, of course, when you get a new person that comes in, like Joshua's been with me now for a few months, 2 months. Okay. And he had never held any gold before. And so the first time you put an ounce of gold in someone's hand or an ounce of silver in somebody's hand, you look at their eyes and they get really, really big. So we have just put together, and we're going to be starting to distribute them actually this weekend at a show that I'm doing. Not all quarters are created equal, because I lift weights, right? And my trainer is actually an attorney turned gym owner. And he's a bright guy, no doubt about it. And one morning we're chatting and I happened to mention that there used to be silver in our money. I don't remember what we were talking about, but it's something like that. And he goes, there was? And he's in his 40s. And he's like, there was? And I couldn't, because this guy is a very bright guy.
Yeah.
And I realized that that's what we have to do. So we've made up these cards, and it says not all quarters are created alike. And we're actually giving away pre-1964 silver quarters next to a new quarter, which looks pretty much the same, except when you turn it on its edge. And then, of course, you can see that the silver quarter is all silver, and this quarter is just base metal with some copper. Well, it's probably not copper, some copper color metal in there with some silver, whatever, plated. So, we're trying to educate the public and understanding that sound money, physical. I mean, this is a $1 gold coin. It's a 20th of an ounce. And this $1, or this isn't actually, this is a new silver dollar, but still that's 1 ounce of silver. Those at one point were equal, and they were also equal to this.
Yeah.
Right?
Yeah.
So there were all of these for 20 years, 1913 to 1933. People were used to using all three of these at the same nominal value, $1. So when they took the gold out of the system, this went away, but people had 20 years of using this, right? And then in 65, that went away. So how many years did we have? Plus the threat that if you tried to hoard the silver as an intrinsic value metal, then our government said that they would sell enough gold to maintain that price at $1.29 an ounce. I mean, I was a teenager then. I was a kid then. I was 10, because I was born in 54. I was a teenager in 71 when they took completely the gold out of it, but it's a process, and it's a long-term process that hides the truth and gives the government the ability to inflate away your work. Because that's really what you work for this. And this is worth less and less and less until it's worth absolutely nothing. And that's where we are. And so when we're talking about the bond markets, or we're even talking about the stock markets, when we're talking about any of these fiat money markets that you can only convert that stuff into this, well, then this is the purchasing power is really what everybody needs to be looking at. And they need to get familiar with what sound money is that are above government's ability to do just that, and central bankers' ability to do just that. This is so critical. Now you see where I kind of get on my soapbox.
I'm with you. And I know my audience appreciates it. I was chatting with Rick Rule last week on this show, and he was essentially making the case that the United States dollar has depreciated by 75% over the last 10 years and will depreciate again 75% more over the next 10 years, given the unfunded liabilities that are facing the United States government and the lack of Treasury interest. Are going to have to continue to inflate and expand and grow the money supply to meet those obligations, which they will probably meet nominally, right? But in a massively devalued currency. Yeah. So we're talking about Social Security and these types of programs, promises the government's made to pay people in the future, with which money they do not have and have no ability to generate. And so they'll have to print it, pay people with that, and continue to devalue the currency. When you hear that, depreciate another 75% over the next 10 years, do you think that's accurate? Do you think that's an overstatement, an understatement? What do you think, Lynette?
I think that is an understatement.
An understatement.
And I'll tell you why. Technically, it doesn't matter what you're looking at. When you get down to the technicals, they all work the same, no matter what you're looking at. And so I'm looking at this issue around consumer confidence and consumer sentiment. And have you noticed that up until the new sentiment numbers that came out that were soaring because President Trump walked back his tariff threats to the EU, right? So they went up. But the readings prior to were many months negative in a row, so much so that last week the reading was the second lowest in history. So my feeling is that as this tariff inflation goes into the system, and remember, smaller businesses are, well, some of them anyway, and even some larger businesses, though they were threatened, so maybe they won't do this, are starting to pull out the tariff tax and put it as a line item on the bills for consumers. Because usually when prices go up, the people just blame whoever's selling the product without really understanding that it comes from policy and policymakers, central banks, governments. They want distance. They want the retailers to introduce that to the public so that the public does not realize who really created that. But if enough companies start breaking out that line item and those prices start to escalate, and I don't think we've seen that very much yet, but I think that lies in our very near future. What do you think that will do to the confidence of the public? And that's the only reason. If they had another more 10 years, it's because they somehow magically managed to retain consumers and the public's confidence in this crap and in those that are in power. And I don't think they can do it. So what I'm really looking for, and the reason why I say 10 years, no, is because once we break that lowest level, which was back in the 80s, right? Once we break below that I think it could potentially be game over. I'm not going to say it exactly, but I've already seen stirrings in monetary velocity and other things that make me believe that we have already entered that hyperinflationary phase. It is just not apparent yet.
That's interesting.
So
your comments about the tariff line item. And I know that Amazon added that temporarily. Bezos seemingly immediately got called to Mar-a-Lago, and then the tariff line item disappeared. But that's Amazon, right? The small business product and service companies that aren't going to get a phone call may start adding that. And that wouldn't really be weird because they already add sales tax. That's there. And for context, that's not there in Europe. What you see on the shelf is what you pay at the till. They don't tell you it's not listed. It's just you're guessing, right? Whereas the United States, the consumer has the privilege of seeing what the price is and what the tax is, so they know, right? And so therefore adding the tariff fee would be in line with present practices. I understand why the administration doesn't want that number listed, but I think you're right.
Now what if enough companies did that and then the public started to realize that, you know what, this tariff tax is not really necessary? Well, maybe they might start to wonder whether or not inflation itself is really necessary. And that's when the confidence goes away. And that's when we enter the visible hyperinflationary phase, because we've already printed plenty of money for it. I agree with you. They're going to print a whole lot more, but it is the only thing that's holding it together is public confidence. Every other layer of confidence is already gone. Bank to bank confidence in 2008, central bank to central bank confidence in 2015, markets to central bank confidence in, I think that was 2020. What was that? 2022, right? So the only layer of confidence left, and this is a con game. This is money that the government dictates what its nominal value is and then inflates away its purchasing power value. And the reality is, if you translate the average income in 1913, $800 a year, and you translate that into ounces of gold today, even though the average wage here in the US, I think is something like 63,000, in terms of those ounces of gold, we make 50% than the people back in 1913. So our standard of living has continued to decline and decline and decline. And what if this isn't just the catalyst for the public to recognize how they have been duped and robbed through inflation? And that's just manipulation.
You know, it's part of me would love to see it. A big part of me would love to see that, right? That grand awakening. I struggle to, I feel like people would be faced with a decision to make. Do they favor voting against the impact of inflation, which means voting to reduce their own entitlement programs, Social Security, et cetera, and what's more painful for them, right? People never vote against their immediate interest, which is why we keep electing politicians who promise to devalue the currency. And, no matter and the debt and the deficit was like the one issue that never came up on any debates campaign trail. Nobody wants to talk about that. There seemed to be some initiatives after President Trump took office that had good intentions. The whole Doge group, of course, which seems to have also dissolved remarkably quickly. I know Vivek Ramaswamy exited stage left quite quickly after that whole thing. That wasn't talked about, but initially there were two chairs of that organization. Ramaswamy was probably concerned about his future political prospects if he was the guy that was cutting expenses left, right, and center. So you're left with an entrepreneur, Elon Musk, who embedded his team, but they didn't actually have the ability to enact any change. They could just suggest changes because they're not an official government organization. But it seemed like they were announcing all kinds of cuts that were available, but mainly sort of like frivolous DEI expenses, like, weird initiatives in Angola, something like this. But once they got loud about focusing on the Department of Defense, all of a sudden the Doge headlines stopped. The momentum seemed to have slowed down. Suddenly Elon is saying he has to go work on Tesla in Austin, and things are getting pretty quiet. And I just wonder, you lift up that hood, you can have all the optimism in the world, but once you actually see how the machine is functioning and you realize the implications of the changes you want to make, and maybe you can't stomach the consequence, even Elon Musk has to back down or was told by somebody, you're going to stop right about here. Similar with the Fort Knox audit, that never happened. It was talked about, a lot of noise. We get into these real things and then suddenly it's like just they're ephemeral. They just seemingly dissolve and vanish. What do you think about that?
Well, I think that my mother gave me very, very wise advice when I was a young woman. And she said to me, when somebody tells you who they are, believe them.
Yeah, it's a great quote. Great quote.
I taught that to my daughters too.
Yeah.
So that's what I will say about that. There's nothing I believe that is off the table. I think it's just the way that they, how they're the visuals of how they want it to look. And while I absolutely agree with you, nobody's going to want to cut Social Security. I mean, there's all sorts of cuts to Medicare that they're discussing. And so we'll see how it plays out. However, when you get your Social Security check and you can't barely buy groceries, you have to eat cat food. I think then people will absolutely realize and acknowledge and lose that trust. So I know they're going to vote first for whatever works for them. I have a much broader view. I think we all have to come together in community as a voice. We can all think different things. We can have really good, open and honest communication. We need to be talking about these things. And we also need to leave space for alternative opinions, right? Every Tuesday at noon here in Arizona, I do a live Q&A, and there are no questions that are off the table. And so people will come in and start talking about crypto or talking about this or that. And, some people will try and shut them down. And I'm like, no, we need to have these conversations. We need different viewpoints so that at the end of the day, we can make educated choices that put our best interests first. What a concept. You cannot count on the government or the central banks or Elon Musk to put your best interest first. That's not the way this works.
Right.
That may be the way they want you to think it works, but that's not the way this works. So community is arguably the most important, because I don't think they're going to be able to maintain it. I'm hoping for 3 years, to be honest with you. I don't even know that they'll maintain it that long, but I hope for another 3.
Maintain what specifically, Lynette?
They can maintain the confidence of the public.
Okay.
That's really the last piece to fall. But when we're talking about the bond markets and the inability to raise as much debt from foreign borrowers, and the run that's already happening on the dollar by proxy between Japan and China in liquidating or not buying as many of our bonds. These are things that are already in place. It's just the general public doesn't know to look for them.
They don't know to look because they're often confused by mind games, and I think about the real estate sector. So I grew up in Vancouver, British Columbia, and people always talk about the housing crisis in Vancouver. The housing's no longer affordable. Mm-hmm. Young people can't get into homes. And that's true. You can also, and then they usually use that as a catalyst to say, therefore, the market's got to crash or correct soon. But you can find those headlines going back to the late 1970s about the Vancouver market getting overpriced, too hot, can't maintain, people can't afford houses. We're 50 years into those headlines now. And the reasons that media always points to, or politicians point to, is, there's an inventory shortage. It's because of permitting challenges. I will fix that for you. Or, it's because of immigration policies being too loose and demand outstrips supply. I will fix that for you, right? And there's all these distraction reasons as to why the house you couldn't afford last year is somehow less affordable this year, when it's just the measuring stick that's changed, right? We keep on polluting the measuring stick, and so the asset looks continually less affordable. But those are the games that are played, right? And so that's why I'd love for a grand awakening for folks to realize the implications of the programs we can't afford to pay for from a government standpoint. But to get there, you got to find your way through this maze of confusing narratives and media coverage that is built to distract you and have you look left while they go right. The old, Kansas City shuffle, right? It's tough. It's tough.
It is really tough. And you can make it actually really, really simple just by that one purchasing power chart. Now, do I think that chart is absolutely accurate? This is from the Federal Reserve, the FRED, F-R-E-D. Everybody's got access to it. Put in F-R-E-D, purchasing power of the consumer dollar, and put your birth date, and you put that in the search bar, and you're going to see this intentional devaluation. And the shift from the sound money to your earlier point about, who's ever held a gold coin in their hand or a silver coin in their hand if you were born after 1933 or again after 1965, right? Exactly. You've never held it. But all that was giving the government more and more ability to debase this and make it look like things are going up, when in reality, it's the purchasing power going down. So rather than being confused, look at that chart. A very interesting exercise is to put your birth date in on the search bar, because you can designate a date, and see how much that they've robbed you since the day you were born.
Oh, interesting. Okay. Yeah. What an interesting experiment. It's such a subtle impact, inflation. Now, if you step back and look at a 5-year or definitely a 10-year trend, it's not subtle at all, but over your day to day, it is. And that's why people don't notice it. Something more dire would definitely turn heads. And I heard you covering this, in Spain. There's recently been some changes to access to cash, as I understand. And you are no longer as free to access your own cash within a bank as you were very recently. And there's, I believe, fines placed on you if you need to withdraw over a certain sum of
3,000
euros. Not very much money, if you need it, right? If you need it.
Right.
So what happened in Spain? What can you tell me about that?
Well, if you want to take out $3,000 or more from the Spanish bank, then you have to actually apply for it through their government agency. If you don't, then there are fines starting at 600 euro to 150,000 euros. And let me, Jay, correct you on one thing. And this is so critically important for people to really actually know is we only assume that that's our cash that we have in the bank. It's not. Once you make that deposit, you have legally loaned them that money. And so it isn't, yes, we're seeing that in Spain, but the reality is I've been witnessing that shift. Well, look, I became a stockbroker. I was a banker in the early 70s, because I started when I was 15, right? But I was a stockbroker in the 80s, and I have watched the globalization and now the part of deglobalization, because the financial system is actually speeding up to globalize it with tokenization and all sorts of other, ways to create additional equity on which these banks can borrow, right? Hypothecation. You make this deposit into this account. It's not yours. It's theirs. And they can now borrow using your equity and go out and do trading. I mean, most of their revenues, bank revenues are generated via trading, not via lending anymore.
Right.
So, I've been in this industry on some level my whole life. And to realize and recognize the shifts that I've seen in our freedoms, as well as our ability and access to our equity. I mean, it's really quite, when you stop and think about it, it's really quite spectacular, because prior to when I became a stockbroker at Shearson in 86. And the big push not just was globalization, but it was gathering assets in-house, right? So that they were held in street name. So most of the assets, if you bought a stock or a bond, you took possession of the certificates. Nobody could use that equity but you. You had that certificate. But they bringing those assets in-house and holding them in street name. So if you're watching, you might want to call your broker or wherever you've got your securities accounts and find out how you're holding them. Because if they're held in street name, that means now all of that equity, they're at the same level of beneficial owner as you are. You're not legal owner, you're beneficial owner. And there are a whole bunch of entities in this major string of entities between the legal owner, which are all the usual, Blackstone, JP Morgan, all the usual players, and you down on the bottom. So all those subsidiaries. And I simply say, look at what happened in 2008 and who went to jail for it. Only some bankers in Iceland, right?
Yeah.
So what they did was horrendous, but you have to understand how much in jeopardy, aside from the inflation risk, the level of risk that you hold when you hold things in the brokerage account, and you don't have any choice anymore. I don't know that they've completely done it with stocks yet, but you can't take possession of a bond certificate, period. And there used to be coupon bonds. Like, you're probably too young to remember that, but you held on to the bond and then you clipped this little coupon and you mailed it in and they sent you money. So the brokerage houses couldn't use the equity that you had in that bond. Now it's all about them using your equity many, 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 many. Did I say many? Many times. So when we go into this next market implosion, and I'm not saying that this yen carry trade unwind could not force this. I'm not saying that the loss of the AAA rating in the US can't force this. I'm not saying that this on again, off again, all of this, back and forth and that the markets are getting used to, this is not normal. What we don't know and we can't see is if something is already irreparably broken. That could be what that yen carry trade unwind, that rise in the Japanese bonds.
Mm-hmm.
That could be what that's all about. And what are they going to walk back now? Because it's not the government or the central banks that raised the rates. It's the markets. And it's the markets that turn away from the U.S. Treasury bond, which is the foundation of the global markets. And so what we have here is this huge doom loop between the bond market and the world turning away from them, but yet that's the foundation. And who can supply it? What, the Federal Reserve is going to go in and buy a whole bunch of bonds? Because, it's the same thing with the Bank of Japan. They own most of the stock market and most of the bond market. How is that really supporting the currency? It isn't.
Yeah, that's fascinating. And
Isn't it?
And especially when I kind of compare those two things, because you talked about the yen carry trade, which is effectively investors borrowing money in Japan at cheap rates, reinvesting that money elsewhere at higher rates, and they keep the spread. That's their margin. That's what they put in their pocket. It's kind of the same thing when you deposit money into a bank. You're loaning the bank that money. They're taking your money. They're putting it to work elsewhere, generating higher interest than they're paying you, and they keep the spread. But companies can default on loans. You're loaning that cash to a bank. They can default. And in that situation, there's always a hierarchy of repayback obligations. Guess what? It's not going to be you or me.
You're at the bottom.
Not going to be you or me, right? But so that, when I think about this situation in Spain, that's where we get to. Banks are realizing a shortage of available capital. So they have to limit what you can take out. Look, we need to keep, if this unwinds, the whole thing falls apart very quickly. You end up in this doom loop domino scenario really fast, which is kind of like, and it's happened in the US, I don't know how recently, but definitely like the Knickerbocker crisis pre-Federal Reserve. That's what it was, right? It was bank runs. JP Morgan himself stepped in, floated the banks, floated the government, and encouraged people, everything will be fine if you leave your cash in the banks. That's right. That on the steps of his library, right?
Right. And so is that why they have put these restrictions around the level that people can take out of the bank?
I assume.
And by the way, I got news for you. You know how hard it is to take out a chunk of cash from the bank here in the US? I don't know what it's like in Canada. Maybe you can talk to that. But I can tell you that you go in and say, I want to take out $10,000. I mean, they treat you like you're a criminal.
Yeah, right.
I mean, they've got the fraud department calling you and, oh my God, we're doing this for your best interest. That's garbage. They are trying to prevent a run because all of those bonds that they accumulated at zero interest rate are all flipping underwater. And so a run on the bank would force sales that are already underwater, which would push them even more underwater. I mean,
well, you think why would a bank put a restriction on what you can withdraw? The only reason is that they're trying to get ahead of a bank run, right?
Exactly.
We're just a bit concerned. The probability of our depositors demanding cash is definitely going up. We want to get ahead of that before that situation actually occurs. So we're going to put some protocols in place that prevent it from happening. You now have to apply. That's going to slow down the withdrawal process. We could actually reduce what some people want. They want 100,000. We'll give you 75. We can do 75 today, right? And they can apply some controls on that and get ahead of that situation. That's wild. Do you know of any other, European, call it like quote unquote developed nations that have similar withdrawal restrictions on their banking sector?
Not overt like Spain has just done, but I would say keep your eyes open because every time something that's extraordinary happens, it's a test. Right. Just like the bail-in in Cyprus, and they try and do it in a smaller place because then people go, oh, well, that happened there, but that couldn't possibly happen here. So I think that it's a test, and depending upon the level of compliance and the the ease of acceptance, we'll see more of that.
That makes
Because
sense.
we're already feeling it here. It's already happening here. It's just not as overt.
Yeah, it's not as overt. And you're right. When these situations happen, we make the mistake often at looking at them like this is an event that occurred in Spain instead of looking at it as precedent. This is precedent that has now been set. Right. And I know in the comments underneath this video, people are going to be going nuts about the confiscation of Canadian bank accounts following the Freedom Convoy a couple of years ago. Right. And, there are a lot of people that are very outraged about it. I think justifiably so. But a lot of folks were like, this isn't a big deal. It happened. They undid it. All right. And it's done now, but my perspective was no, precedent was set. Right. The door is open now. That's happened recently. The second time it'll be less of a thing. That's how precedent works, right? And how we change major policies slowly, and then all at once, seemingly. But
exactly. How do you catch a wild boar? You got to have patience. You just put some food out in the same place every day. They start to gather there, and then you put up this one side of the fence and the corral, and then another until you've captured them. But you've got to have patience, and you do it slowly.
Yeah.
So that's why when I sit here and say, look, in my indicators, I already believe that we have already entered the phase where we are going to see hyperinflation. We just aren't seeing it yet, but it's already there. The bond market structurally is already different, right? The fact that people don't see it is irrelevant to the fact that the bond market is structurally different, and we are seeing the impact of that and the lack of liquidity, which means the ease to buy and sell. I mean, the volatility, and you can actually see it in charts. They don't publish this anymore, but thank goodness I knew enough about print screen at that time to capture it. But you can actually watch the evolution on the, and if you want, I'll send you this chart so you can put it up. The TYVIX, which is the volatility index on the 10-year Treasury. And they stopped reporting in 2016. But you can watch in the beginning that the price of the bond was like a dash, right? And that meant that the price didn't fluctuate a whole lot on a day-to-day basis. So if you were holding treasuries and you wanted to buy them or sell them, you could pretty much tell what you were going to buy or sell them for, because the price action was in a dash. It didn't move very much. And that's the way you want a foundation. But when 2008 hit, which was once a dash, now became more volatile, straighter up and down line. That means that there was a lot more price fluctuation on a day-to-day basis. So you didn't have at that level of certainty. But again, I go back to 2013. 2013 was really quite a pivotal moment, and people have no idea about that, because that's really when the Treasury bond market was handed over to traders who are short-term thinkers. And so what was once this and then went to that went like this, and then they stopped publishing it in 2016. So God only knows. Now they publish it in a different way, but you can't see it. It's not as visible. So if it was like, what is the thing that I'm not medical at all, that they check your heart, right? A cardio, whatever it is, a machine. Oh. Yeah. Okay. It looks like the U.S. Treasury bond market is having a flippin' heart attack.
Right.
Right. And now we can't even see it. So it's not what we can see. Somebody asked me yesterday, so what is it that you can't see that you think might come to disrupt everything? I don't know. I can't see it. I don't know.
Yeah.
Right. But there's a lot of those that are happening in the derivatives market. You cannot tell me that the volatility, especially when we had that structural shift in the bond market in 22, you can't tell me that explosions didn't happen. You can't tell me that, because I won't believe you. But because the guys that create this garbage and this mess can determine whether or not there's a default on it. This is a very opaque market. And that's why the public ends up being shocked when it becomes visible. But this erosion has been going on. I mean, I said it at the time, I will maintain it today. The whole system died in 2008, and it was just put on life support opium and lots of this stuff to make people think that we were somewhat back to normal. But we are not nearly back to normal, and people will start to recognize that with higher inflation.
Mm.
You know, that's what people notice. You go in to buy that loaf of bread and it's $1 more than it was last week. You know, slow. Yeah. Fast inflation. They notice.
Yeah. Yes. Now you mentioned sort of the black swan concept, the major crisis that you can't see coming. What's it going to be? Well, I don't know, because that's the definition of a black swan event, right? And it's only so impactful because nobody expects it. The things we know are coming, they don't impact us nearly as much because we get ready for them in advance, right? Therefore, black swan events aren't black swan to everybody, just the majority of people who aren't prepared, right? Which we talked about a lot of very sort of parabolic events today, hyperinflation, bank runs, defaults, et cetera, which can be black swan events if you're not looking that direction. And suddenly they just, hit you from behind. There's obviously things you can do to prepare yourself for financial crises, right? There's all sorts of crises that are harder to prepare for. Financial crises is just one, and there's strategies you can employ. I know you focus on that at Zang Enterprises. So I just want to maybe walk through at a high level, as much as you can, the Zang Enterprise strategy, crisis preparedness, in a financial crash.
Right. So I'm going to give you a big overview because, I don't have an exact date, but we'll bring out Prosper and Plenty. But I have a mantra, and I think community has risen to the very top of my priority list, because while I knew the system died in 2008, so I've been preparing ever since then. But you've got to make sure that you have surety in food, water, energy, security, barterability, which for me is primarily silver, wealth preservation, which for me is primarily gold, community. You've got to build this community both locally and globally, and you got to have shelter. So these are all things that we need to sustain a reasonable standard of living. Now, the sound money strategy that Zang Enterprises employs is based on, I've been studying currency and currency life cycle since 1987. So it's based upon those repeatable patterns, and it's designed to put you in the right place at the right time with the right asset, so that not only are you okay, you've managed to sustain your current standard of living, you've managed to properly diversify and therefore protect the wealth that the fiat money wealth that you've already managed to accumulate, and also your real estate wealth. And then the next level of it is to put yourself in a position to take advantage of the opportunities, because like you discussed earlier, the pricing of houses and how that has really priced people out of the market. But what you do is, we know this 100%, fundamentally gold and silver are severely undervalued, where those other assets, because they've been targeted for reflation, are extraordinarily overvalued. That's going to flip-flop. And the whole point of holding gold and silver as a bridge from one currency into this next iteration is to maintain your purchasing power through this transition and put you in a position to take advantage when that flip-flops. And we see who's going to survive this mess, because that's a big question right now. But all that debt and all that leverage in the system, it's got to be burned off, period. So that creates opportunities as long as you can hold your purchasing power. And that's really the single most important function of an ounce of gold. So at Zang Enterprises, that strategy is very layered, so that wherever you are in this trend cycle, you can accommodate whatever it is that you're trying to accomplish, because it all starts with your goals. period.
Mm-hmm.
So that's what we do. And we do sell physical gold and silver. I have to say that because a lot of times people don't realize that. But we do sell physical gold and silver, which is sound money. And we do support sound money globally. So what I'm trying to do is I am part of the sound money movement. And we are doing this both on a local basis, like Florida just legalized gold and silver as legal tender. Yay. So we're working on the states to legalize gold and silver as legal tender, which then should put pressure on the federal government to do it, just like it did with the marijuana laws. But globally, if we can get 3% of the population to convert their garbage fiat into sound money, I think we got a shot at having a seat at the table in the new iteration of money. And if I'm the person that's sitting at the table and what I'm fighting for is redeemable gold money, not pegged, even though they'll say that it's backed. You must have the ability to hold these officials' toes to the fire. We gave it up in this country in 33. I say, let's take it back and let's do it on a global basis. This is much bigger than just the US. And that's my battle. And it's my battle for my children, my grandchildren, my great grandchildren, and on and on. If we don't do this, we're screwed.
Let me ask you a question. This came up last night. I was hosting a masterclass for my commodity university students. This is a online course platform for anybody who's brand new to investing in the commodity sector. The whole catalog of courses, 11 instructors. We do monthly meetups. Last night, somebody asked me, what's the right allocation of physical? Now, we spend most of our time talking about equity portfolios. So we get into position sizing and investments versus speculations and how to position accordingly. Somebody brought up, he's like, do you include physical in your wealth portfolio? We talk about position sizing. And if not, how do you determine the right allocation of physical gold? And it was, it's such an interesting question because I find that to be very objective. It's like, well, I have my own personal needs and demands based on my situation. I got 3 young kids. They're completely dependent on me. I need a bigger safety net than most people, I think, or than I used to 10 years ago. Better context. How do you counsel somebody who asks you, what's the right amount of physical for me to own?
I love that question so much. That's where, there's 2 different values. Wall Street wants to sell you on intrinsic value, which is based on their formulations and easy to manipulate. But I say you need to look at the fundamental value, which is the true value of any instrument or any asset. So when we're building a portfolio and we know, okay, you've got this much in your stock portfolio, right? Using the fundamental value of gold and silver helps us determine how much gold do you need to properly diversify that intangible portfolio. So we use the fundamental value to determine what that is. We also have it broken down in the barterable part of the portfolio. This is where we're taking into account your current standard of living. And we have it divided up into barterable silver and barterable gold. So as example, if I'm analyzing a portfolio and making a recommendation, I'm going to look at what your day-to-day expenses are. Your food, maybe your gasoline, those kinds of things. And then I'm going to suggest how much silver you need based on that. But things like property taxes, right? Things like chronic illnesses that you might be dealing with, that kind of thing, then that's where you want to go to the barterable gold. But the determination of how much you need is based on the fundamental value, not what Wall Street wants you to believe is the intrinsic value, but the true fundamental value. Because I really can't give you a lot of guarantees, but I can guarantee you this. At some point, all assets end up at their fundamental value. And going back to that purchasing power chart, because when you're an intangible portfolio that you can only convert into these, the real trend is not what's happening with that stock or the markets or any of that. The real trend is in the purchasing power value. And if you look at that graph, you'll see where it started out at $1, and you'll see down at that bottom on the left-hand axis, a big fat 0. Big fat 0. So we can determine that's the true fundamental value of one of these. I mean, I have a $10 trillion Zimbabwe note. It doesn't matter what it is. I can't buy anything with it. So you need to understand the true fundamental value of whatever it is that you're doing, and then the appropriate balance, the appropriate diversification to protect that. Then do whatever you want after that, because you can sleep at night, whether you're right or whether you're wrong, which is pretty much how I like to operate. I don't have I'm not a very good short-term trader. That's just not where my mentality is. I am a long-term strategist, and that's the way we determine it.
Well, I think that's the smart way to play it. That's funny. That came up last night as well, time horizon. And it's my firm belief that nobody can time the market. None of the pros that mentored me claim to be able to time the market. It's just the rookies that think they can do it, call the bottoms and call the tops. They learn the hard way. You have to learn the hard way. And one thing you said there was effectively, once you've built this strategy, then you can go about your daily life, because people often get caught in this, like, well, I don't want to be a pessimistic prepper, obsessing over the end of the financial system and therefore my global economy. It's like, no, just put some things in place and then proceed and participate in the upside. I'm very optimistic about our future. Like I
am too.
I'm long human ingenuity and progress. Like we're going that direction. But you can move that direction from a place of confidence if you put some things together, call it your base, your foundation, the just in case, part of the portfolio that can weather that storm if and when, and cyclically it's when they occur. Right?
Exactly. And, and when you stop and think about it, because people will say that for me, I mean, I'm an urban farmer. I have a bug out place and I've got orchards and stuff up there, and I own a lot of gold and silver. If I'm wrong about this, which I'm certain I'm not, but if I am, booty hooty Rudy Manooty. I have a great place to go on the weekends that's 30 degrees cooler than it is in Phoenix. And I own lots of gold and silver, of which there is global demand. Boo hoo hoo.
Yeah. There's no downside.
There is no downside. And that's the way I like to operate. Then I don't have to worry about it. I can sleep at night.
I love that. Look, Lynette, it's always great chatting with you and catching up with you, getting your perspective on a handful of events today. Thanks so much. Where should we send people today who heard the Zang Enterprises strategy, but they want to take the next step? Where can I point them?
Well, first of all, LynetteZang.com is the website. We love in-person conversations. Our number, which is, I love this number, 833-GLD-ZANG. So it's kind of easy to remember.
Nice work.
But very prolific on YouTube and Twitter at the Lynette Zang, and Instagram and Facebook at Lynette Zang. I'm all over the place. So I try and be very accessible.
Nice work on that phone number. I love that.
Yeah, isn't that awesome?
Gold Zang, GLD Zang. All right. Thanks so much, Lynette. I look forward to the next time, and all the best.
When you think about the difference of poor versus wealthy, we all wake up with 24 hours every day. And so then it comes down to the things that we're doing in those 24 hours, and a lot of it has to do with the mindset. What Dave Ramsey and every other financial advisor tells you to do is work for 40 years, save enough money, so one day, hopefully, you could retire and live off of your savings. And if you're lucky enough, you'll die right around when your savings hit zero. I want to know that number down to the penny. Not, it's $10,000. No, it's not $10,000. It might be $7,479.27. I want to know that number.